Welcome back, everybody, to another deep dive. This time we're diving deep into the world of financial crises. With this book, A Crash Course on Crises, as our guide.
Oh, yeah. This should be a good one.
Yeah, it looks super interesting. We're going to try to understand how those seemingly small events
Right.
can spiral into these huge global economic meltdowns.
Yeah. The book breaks it down really well.
Yeah, it does. It's got a good structure, I think, for this deep dive, too. The book looks at the lead-up to a crisis first, and it digs into the triggers and how they spread, and then finally how things recover. So that's how we're going to tackle this deep dive today.
Sounds good.
The book's intro immediately grabbed my attention with that story about Isaac Newton,
Oh, yeah.
the gravity guy, Well, he got caught up in the South Sea bubble and lost a fortune. And then he's quoted as saying, "I can calculate the motions of the heavenly bodies, but not the madness of people." If Newton couldn't predict market madness, what hope do we have?
Well, the book goes beyond just saying people are irrational. It digs into how rational decision-making can actually fuel a bubble. And they explain it using this concept called the Keynesian beauty contest.
A beauty contest for the economy.
Yeah.
Okay, I'm intrigued.
So imagine you're trying to pick the winner of a beauty contest. You might not choose who you think is the most attractive.
Right.
You're going to pick who you think everyone else will choose as the winner.
Oh, so you're trying to anticipate the crowd's perception.
Exactly.
It's like your own.
Exactly. It's not about individual taste. It's about understanding the collective psychology of the crowd.
So applying that to the markets, even if I think a stock is overpriced, if I believe that everybody else is going to keep buying it and push the price higher, well, it might make sense for me to jump in on that too.
Right. It's that shared belief that drives bubbles.
Huh.
And it can be tough to resist even for those so-called smart money investors.
Like hedge funds.
Exactly.
Which leads us to some real-world examples. Yeah. The book mentions the Japanese real estate bubble in the late 80s. Unbelievable. The book says that at one point, the land around the Emperor's Palace in Tokyo was supposedly worth more than all of California.
Yeah, and the Japanese case really illustrates what happens when you get this combination of extrapolative expectations and financial deregulation.
Extrapolative expectations.
It's the belief that current trends will just continue indefinitely.
Ah, okay. So people assume the market's going to go up forever.
Right. And when you combine that with easier access to credit thanks to financial deregulation...
You get a recipe for a bubble.
Exactly.
Of course, it didn't end well.
No.
Japan's economy stagnated for decades after that bubble burst.
Right. They call them the lost decades for a reason.
Makes sense. And then there's the dot-com bubble of the late 90s, which even sucked in some of those hedge funds.
Yeah, but what's interesting about the dot-com bubble is that unlike a lot of other bubbles, it wasn't really fueled by debt.
Really?
Yeah. Investors were mostly using their own cash to buy those tech stocks.
So when it crashed, it didn't have that same kind of ripple effect on the whole economy.
Exactly. It was more of a localized implosion.
Interesting. So we've seen that debt, or leverage, as it's sometimes called, can play a huge role in turning a market bubble into a full-blown systemic crisis.
Absolutely. Leverage magnifies everything. It can supercharge the booms, but it also makes the busts way more painful.
Okay, so far we've got these speculative bubbles.
Right.
Fueled by crowd psychology and the potential for excessive debt to amplify things. Now, the book also talks about these massive inflows of foreign capital that often precede a crisis.
Yeah.
At first glance, you'd think more investment is a good thing, right?
Yeah.
More money, more growth.
It seems that way. But the book argues that these huge capital inflows don't always go to the most productive parts of an economy.
Oh, I see.
It can lead to what they call misallocation, money flowing into inefficient or unsustainable businesses, creating these zombie firms and hidden vulnerabilities.
The book's example of Portugal adopting the euro was a real eye-opener for me. They joined the Eurozone in the early 2000s, hoping for prosperity. But what happened? Their economy fell into a 20-year slump, the worst in over a century.
Yeah, Portugal's experience is a cautionary tale. It shows how these large capital inflows, while seemingly positive, can destabilize an economy if they lead to misallocation.
It's like flooding a garden. Too much water in the wrong places can actually drown the plants instead of helping them grow.
Exactly. And it reminds me of Chile in the 1970s. They went through a very similar boom and bust cycle after rapidly opening up their financial system.
So there's a pattern here. These sudden, massive inflows of capital often create more problems than they solve.
Often, yeah.
Yeah.
It's not always the case, but it's something to watch out for.
Okay, so we've got speculative bubbles, misallocated capital inflows, and excessive debt all brewing. Feels like we're building up to something big here. And then on top of all that, you've got the evolution of banks themselves.
Right.
The book talks about the rise of modern banking and this thing called shadow banking, which sounds a little ominous.
Yeah, well, traditional banks, they take deposits and make loans. But modern banking has become much more complex.
Yeah, with all those fancy financial instruments.
Exactly. And that's where shadow banking comes in.
So what is shadow banking exactly?
Think of it as the less regulated cousin of the traditional banking system.
Okay.
It involves these complex financial instruments, often with high levels of leverage, and it operates outside the traditional regulatory framework.
So more complexity, more leverage, and less oversight.
Yeah. And it all raises some serious questions about systemic risk.
Meaning?
How vulnerable this whole interconnected system is to shocks or unexpected events.
That brings us to the U.S. subprime mortgage crisis.
Ah, yes, a classic
Of
example.
what I understand, securitization played a big role there.
It did. Remember, securitization is where you bundle loans together, like mortgages, and then sell them off as investments.
Right.
Well, this allowed lenders to move those subprime mortgages, which were considered high risk, off their book.
And make it seem like everything was fine.
Exactly.
Yeah.
And these mortgage-backed securities got sold all over the world, fueling this massive housing bubble.
And then those subprime mortgages started defaulting.
And when they did, the whole house of cards started to crumble. The fallout wasn't limited to the U.S. either.
Right. It triggered a global meltdown.
Because everything was so interconnected.
So even though these mortgages were in the U.S., the impact was felt worldwide.
Exactly. And the Spanish credit boom in the 2000s provides another interesting parallel.
How so?
Well, they had these banks called cajas, regional savings banks, that focused heavily on real estate lending. Very similar to what happened with the U.S. savings and loan crisis years earlier.
So both countries had these concentrated lending practices.
Right.
Focused on real estate.
Right.
And when the bubble burst, it exposed just how vulnerable the system was.
It all comes back to that idea of systemic risk.
Problems in one part of the system can quickly spread to others.
Exactly. Especially when there's a lot of interconnectedness and leverage amplifying things.
Okay, so it seems like we're standing on pretty shaky ground here. We've seen how bubbles, capital flows, and the evolution of banking can set the stage for a crisis. But how did these vulnerabilities actually transform into a full-blown economic meltdown? That's what we'll explore next time.
Looking forward to it.
Me too.
See you then. Welcome back to our deep dive on financial crises. So last time we talked about the things that make economies vulnerable, like speculative bubbles.
Right, those misallocated capital inflows.
Exactly, and the rise of these super complex financial instruments.
Yeah, it feels like we were laying the groundwork for disaster.
We were. In this part, we're going to see how those vulnerabilities actually get triggered and turn into a full-blown crisis.
Yeah, it's always fascinated me how a few bad loans or a dip in housing prices
Right.
can suddenly spiral into this widespread panic, economic collapse.
It all comes down to something called systemic risk.
Okay, so what is systemic risk?
Think of the financial system as this big network of interconnected parts.
Okay.
When one part of that network starts to fail, it can create this ripple effect that spreads through the entire system.
So one bank's problem can quickly become everyone's problem because they're all connected.
Exactly. The book uses a great analogy to illustrate this. Imagine a group of banks all lending to each other and holding similar assets.
Okay.
Now, say one bank starts experiencing losses and they need to raise cash fast. What do?
They sell off some of their assets, right?
Right. But here's the problem. Those asset sales can drive down prices.
Well.
And if other banks are holding those same assets, they start seeing losses on their books too.
It's a domino effect.
Exactly. And this can force them to sell assets as well, further depressing prices and creating this vicious cycle.
So it's not just the initial loss, it's this downward spiral that it creates.
Exactly. And this can spread across borders too. Think about the Asian financial crisis back in 97, 98.
Oh yeah, that was a big one.
It started in Thailand with a currency devaluation, but it quickly spread to other Asian economies as investors lost confidence.
They started pulling their money out.
Right. And what's really fascinating is that the Asian crisis even impacted countries that seemed totally unrelated, like Russia and Brazil.
Wow. So even countries that look financially healthy can get caught in the crossfire.
Absolutely. It shows you just how interconnected the global financial system is.
Okay, so how about the Irish banking crisis in 2008? How did systemic risk play a role there?
Well, Ireland's a good example of how a country's financial system can become really vulnerable to shocks that start somewhere else.
Okay.
Their banks had become heavily reliant on foreign wholesale funding,
Wholesale funding meaning so.
borrowing large sums from other banks, often for very short periods.
Huh.
Now, when the U.S. subprime mortgage crisis hit, those foreign lenders got spooked and started pulling their money out of Ireland.
So Irish banks, which were already overexposed to their own real estate bubble,
Right.
were suddenly starved for cash.
Exactly. And they were forced to sell off assets to try to cover the shortfall. But as we discussed earlier, those asset sales just made things worse.
Driving down prices and deepening the crisis.
Right. It's a classic example of how systemic risk can amplify a small shock into a massive economic disaster.
Okay, so this brings up an important question. How can you tell if a bank, or even an entire country, is truly insolvent? Meaning they can't meet their financial obligations.
Right.
Or if they're just facing a temporary liquidity crunch.
That's a crucial distinction, but it can be super hard to tell, especially in the middle of a crisis.
Yeah.
Let me use an analogy. Imagine a business that needs to refinance a loan to keep a project going. If interest rates suddenly spike, they might struggle to get that refinancing even if the project itself is sound.
So they're not bankrupt. They just don't have enough cash on hand at that moment.
Exactly. But that temporary cash shortage can create this dangerous snowball effect. If creditors lose confidence, they might refuse to refinance. The business might be forced to liquidate assets at fire sale prices just to get some cash.
And that can actually make them insolvent.
Right. It becomes a self-fulfilling prophecy. The fear of insolvency can actually cause insolvency.
The book gave that example, the German banking crisis in 1931. Weren't there runs on the banks?
Yes. Fears about bank insolvency triggered massive withdrawals.
Everyone wanted their money back.
Exactly. And this forced some banks to collapse, even though their underlying assets might have been perfectly fine if they'd had more time to recover.
So the panic itself became the real problem.
Exactly. That's why central banks are so important during a crisis.
Right, because they can lend money to banks that need it.
Exactly. They act as the lender of last resort, stepping in to provide emergency liquidity to banks that are solvent but illiquid. This can sometimes prevent a panic from turning into a full-blown systemic collapse.
But didn't the central bank kind of drop the ball in the German case?
Well, at the time, Germany was on the gold standard, which limited the central bank's ability to print money and provide liquidity.
So their hands were tied.
In a way, yes. And those constraints ended up making the crisis worse, turning a potential liquidity crunch into a systemic banking collapse.
It's a reminder that even well-intentioned policy responses can backfire during a crisis.
Absolutely. You have to be very careful.
Okay, how about the Greek sovereign debt crisis back in the early 2010s? Was that a solvency issue or a liquidity crisis?
That's a question that economists debated for years.
Yeah, I remember that.
Initially, the IMF thought it was a liquidity problem and bailed Greece out.
But that didn't really fix things, did it?
No, Greece's problems continued and interest rates on their debt kept going up. This suggested that investors were worried about Greece's ability to repay its debts in the long run.
They were worried about solvency.
Exactly. And as it turned out, those worries were justified. Greece eventually defaulted on its debt.
It just goes to show how hard it is to tell the difference between solvency and liquidity problems.
Especially in the heat of the moment. Sometimes what looks like a temporary cash flow issue can actually be a sign of much deeper problems.
Okay, now the book also talks about how banks and governments are intertwined during a crisis. They use this term, diabolic loop.
Right. It refers to this vicious cycle where bank losses on government bonds weaken the government's finances. And that can lead to even more losses for banks as the government's ability to repay its debts comes into question.
It's a self-destruct button.
Yeah, basically. And the book uses Ireland's bank guarantee during the 2008 crisis to illustrate this. To try to prevent their banking system from collapsing, the Irish government guaranteed all bank liabilities.
Wow, so they were on the hook for everything.
Basically, and while it was well-intentioned, it ended up backfiring. The guarantee created this massive liability for the Irish government.
And forced them to seek a bailout.
Exactly. It's a cautionary tale about the unintended consequences of government intervention.
How about Argentina in 2001? They did something different, right?
Yeah. Instead of guaranteeing their banks, the Argentine government forced domestic banks to buy government bonds.
They used the banks to prop up their own finances.
Yes. which temporarily hid the true extent of their fiscal problems, but it just delayed the inevitable. When Argentina finally defaulted, it triggered a banking crisis, too.
Because the banks were holding all those worthless bonds.
Exactly.
It seems like there are no easy answers when it comes to managing a financial crisis.
There aren't. It's incredibly complex, and every situation is unique.
Okay, so we've talked a lot about the economic factors that drive a crisis. But what about the psychological side of things?
Ah, yes, the human element. That's just as important as the numbers in the charts.
The book talks about this flight to safety that happens during a crisis.
Right. When fear takes over, investors tend to act emotionally rather than logically.
It's sell off anything that seems risky.
Right, and they flock to what they perceive as safe havens, like U.S. government bonds or gold.
It's like everyone trying to squeeze into the same lifeboat.
Exactly. And this flight to safety can actually make a crisis worse. It can drive up borrowing costs for countries that are already struggling, making it harder for them to recover.
The Eurozone crisis is a good example of that, right?
It is. As doubts grew about the solvency of some of those peripheral Eurozone countries, investors piled into German bonds, which were seen as the safest asset in the Eurozone.
So German interest rates went down while rates for countries like Greece went way up.
Exactly, making their debt problems even worse.
It's a vicious cycle. Fear drives investors to seek safety. But that can actually make things riskier for the most vulnerable.
Precisely. It highlights this complex dance between economic reality and investor psychology that plays out during a crisis.
Okay, so we've covered a lot of ground here. We've seen how those vulnerabilities we talked about earlier can get triggered and turn into a full-blown crisis.
Right.
We've also seen how hard it can be to distinguish between a liquidity crunch and a true solvency crisis. And we've touched on the psychological factors that can amplify things even further. So now that we've explored the dark side of financial meltdowns, let's move on to the recovery phase. How do countries and economies actually rebuild after something like this? That's what we'll dig into next.
Sounds good.
All right, so we've made it through the crashes. Now the question is, how do countries and economies actually rebuild after a financial crisis?
The recovery phase is super important. You're not just trying to get back to normal. You're trying to build a stronger system for the future.
It's like recovering from an injury. You don't just want to heal. You want to come back even stronger than before.
Exactly.
Now the book talks about the role of exchange rates in the recovery. And that's always kind of confused me. It seems like a weaker currency should be good for a country that's trying to bounce back.
Right. That's the conventional wisdom. And in a normal recession, it often makes sense. A weaker currency can make your exports cheaper, boosting demand and helping to stimulate the economy.
But financial crises are different.
They are, especially for those emerging economies that borrow a lot in foreign currencies, like U.S. dollars.
Ah, the original sin, as the book calls it.
Right. Borrowing in a currency that you don't control, that can come back to bite you if your own currency starts to slide.
Yeah, if a country has a bunch of debt in U.S. dollars and their currency depreciates suddenly, that debt gets a whole lot bigger.
Exactly. And that can really squeeze businesses and hinder the recovery.
It can turn a depreciating currency from a potential benefit into a huge liability.
It's like thinking you got a great deal on a vacation package. But then the exchange rate changes, and suddenly you're paying way more than you planned.
Ouch. The book mentions Mexico's tequila crisis in the 90s. They tried to devalue their currency to boost exports, but it ended up triggering massive capital flight.
Investors got spooked and pulled their money out,
leading to economic chaos.
Exactly. It shows how exchange rate policies can be risky during a crisis.
It's a delicate balancing act.
It is. And even when things start to calm down, you often see this lingering effect on investment and growth.
Businesses and consumers are still hesitant to spend or invest.
Right. And that can lead to a prolonged period of stagnation, like what we saw after the 2008 crisis.
So even after the storm passes, it can take a long time to really recover.
It can.
Okay, so let's talk about the role of central banks in all of this. We talked earlier about how they can act as a lender of last resort, but they've got other tools too, right?
They do. Central banks have become much more creative over the years, especially since 2008. They've had to use what were once considered unconventional monetary policies.
Yeah, all that quantitative easing and forward guidance.
Exactly. Those have become pretty standard these days.
Can you remind me what those are again?
Sure. So quantitative easing, or QE, is when a central bank buys assets like government bonds. This injects money into the system and helps lower long-term interest rates.
So it's like giving the economy a shot of adrenaline.
It is. And then you've got forward guidance, which is more about communication. The central bank signals its intentions, promising to keep interest rates low for a long time, for example. This can help to reassure markets and encourage businesses to invest.
So it's about providing some certainty in a really uncertain environment.
Exactly. The Bank of Japan was a pioneer in both QE and forward guidance. They've been using those tools aggressively for years.
And the European Central Bank did something similar during the Eurozone crisis, right?
They did, although it was trickier for them because you've got multiple countries with different fiscal policies, all using the same currency.
Well, it's like trying to steer a ship with multiple captains.
In a way, yes. But the ECB did eventually step in and provide enough liquidity to stabilize things.
Okay, so central banks play a big role in both managing crises and fostering recovery.
Yeah.
But what about governments? What can they do?
That's where fiscal policy comes in. Financial crises can lower what economists call the natural interest rate. And when that happens, you can get stuck in this liquidity trap where traditional monetary policy becomes less effective.
So even if central banks cut interest rates, it doesn't really do much.
Right. And in that situation, government spending can help stimulate demand and pull the economy out of that trap.
So it's not always about austerity measures and cutting spending.
No. Sometimes you need to spend strategically to get the economy moving again.
And the book makes the point that government spending is actually more effective during a crisis when interest rates are already really low.
Exactly. There's less crowding out of private investment because businesses already have access to cheap credit.
So it's like pushing on an open door. The impact is bigger when the economy needs it most.
A good analogy. And the recent surge in household savings during the pandemic is a great example of this. All that pent-up savings could fuel a spending boom, pushing up inflation.
Wow. So we've come full circle in our deep dive into financial crises. We started by looking at the things that make economies vulnerable.
Right, those bubbles, misallocated capital, excessive debt.
Then we saw how those vulnerabilities can get triggered and turn into a full-blown meltdown. And finally, we look at the long and difficult road to recovery.
And we've seen how central banks and governments can play a role in both preventing and managing these crises.
It's clear that financial crises are complex with so many interconnected factors. But hopefully this deep dive has shed some light on how they work and what we can do to prepare for the next one.
I think so. It's all about understanding those underlying vulnerabilities and taking steps to build a more resilient system.
Well said. That's all the time we have for today, but I want to thank you for joining us on this deep dive into the world of financial crises. And a big thank you to our expert for sharing their insights. It's been an enlightening conversation.
It has.
We'll be back soon with another deep dive into a different topic. Until then, stay curious and keep learning.
Thanks for tuning in and helping us carry off these deep dives, as I call them. Be sure to like and follow the video so we can keep them coming.
See you soon.